Money!
What Your Bank Doesn't Tell You, a podcast by You Mushroom.
Welcome to our podcast series, What Your Bank Doesn't Tell You. We're having a very special guest today. It's one of our partners from Invesco, and I have the pleasure to present Nima.
Hello, Luba. Thanks for the invitation.
Nima has an amazing background. He actually knows the value chain of producing ETFs, really starting from the core. I think I can say that.
Yeah, more or less, yeah. You can.
So you're currently heading the ETF business for Switzerland for Invesco.
Correct.
And we're proud to say that thanks to you and your efforts and the efforts of the team, you actually managed to really be one of the key players on the Swiss market.
That's correct. Do you want me to briefly speak about the background, how I entered the ETF space?
I'd love to. I think it's always better to hear it from the person itself. So please go ahead.
Yeah. I mean, European ETFs exist since 2000. Yeah. So we are now 2 decades into the ETF market. If you think in the US, it started in the 90s, beginning of 90s. So a decade before Europe. In the US, we had index funds, obviously, in the 70s. I started my career, it was around 2006 to 2008 in Frankfurt for Deutsche Bank, where my task was I was a junior looking for ETFs, the niche. Yeah, no one wanted to look at those, so they said, hey, why don't you cover the ETFs? Back then, it was around 50 billion in total, and the total size of the European ETF landscape. So you cover all the ETF providers, you had in total 50 billion. So it was non-existent. And yeah, so being a multi-asset PM for DWS back then, selecting ETFs, I entered the ETF space, over a decade ago, and then came to Switzerland 10 years ago for DBX trackers and joined Invesco ETFs 7 years ago. So that's a bit my entrance into the passive ETF space.
That's a very impressive background, Nima, and it's great to get to know someone who actually started from the beginning.
Yeah.
I remember that time, back then in 2007-8, I was with Credit Suisse.
Yep.
And I remember that we only just started looking at ETFs, but no one was talking about the product, which currently actually is the main product if you want to invest into the broader markets.
Yeah, definitely. I mean, if you look, it was in 2000, the first 2 Euro stocks ETFs were launched. Then when I was looking at ETFs, it was really a small limited number of ETFs. And then we had also the replication physical, and then later on there were some synthetic ones, but it was really limited number. And if you look now, there are more indices out there than stocks, which is crazy, right?
That's actually very interesting. I didn't know that. Really?
Yeah, it is.
So there are roughly, if I'm not mistaken, 45 to 50,000 stocks global. And you'd say, oh, wow, impressive.
So there are more indices out there nowadays.
Wow, so interesting to know. Yeah. And maybe to put a rough, how shall I say, relation to what we were just discussing. Sure. You said when you started, the market was 15 billion. Yeah. And currently... It's
1,500 billion.
It's crazy.
Which is crazy, yeah. And if you look within the next 5 years, there's studies from PwC, for instance, who say the European ETF market will grow to 2,500 billion in size. And where is it coming from? It's retail. It's everyone.
Like you
it's
and
like
I,
you and I, everyone who is going to invest into ETFs, self-directed.
Yes.
Yeah. So that's the beauty of ETFs.
And I think the interesting thing is also it's a very low-cost product by nature, how it is structured, because it's very, for those of you out there who wonder what is an ETF, we keep saying always, also for the educational purposes, an ETF, with an ETF, actually, you can invest in the broad market. And me as a retail, if I have to buy, for example, the SMI market, I would need to buy 20 stocks, and I would need to take quite 10,000, basically, Swiss francs and more, depending on where the index is. And with an ETF, I actually, which is tracking the SMI index, for example, I'd be easily starting with, I don't know, depending on the price, with 70, 80, 100. It's a fraction of it. And that's actually, by the way, also a very elegant way to start investing in small pieces, obviously, for those of you who want to learn. So we're going currently in a market downturn,
Yeah.
and no one predicted that actually the stock market, particularly the US stock market, would would go 20% plus, or currently a bit less year to date. And we hear from a lot of people out there now, and one of the questions which most often reaches is, shall I continue investing or shall I start investing now? Happy to hear your opinion.
I mean, there are a lot of academia papers on that. It's called behavioral finance. Yeah. And so in the end of the day, you really need to not react emotionally. That's the most important thing. And if you look at value investors like Warren Buffett, for instance, what he did was really steady investments over a long time period. And no matter if there's a downturn or not, it's actually a good moment to invest into the market because you buy stocks cheaper, right? So don't really get confused if you see a downturn, negative signs, red signs on the stock market. Just keep on investing, not your entire amount at once, obviously, but step by step, month by month, and with a limited number, and then it's the best timing. And if you look, I mean, over the period, the stock market performs around 8% per annum. Yeah. But you shouldn't really start timing the market. Just be invested in the market and over long term, and most of us have a couple of years still to go, you should stay invested and keep on investing into equities.
I couldn't agree more, because it's actually, this saying which says, the famous sentence from investing saying, actually, the time in the market beats market timing. And there is no such thing as absolutely perfect market timing. You can't time the market, as you say. It makes sense to be invested. And one of the biggest mistakes which young investors particularly do is to say, now it's starting to drop, maybe it will drop, let me wait a little bit. And then it goes up again very often. And people are like, oh my God, I missed it.
I mean, there were, Costolani, he said, take a sleeping pill, and then wake up and then look at your portfolio. So it's literally that. Yeah,
it's absolutely true. I would love to hear, you recently launched an interesting product, FTSE All World. And for those of you who don't know a lot about Invesco, that's actually the fourth biggest ETF provider worldwide. You guys are truly global, right?
Yes.
And across asset classes as well. Equities, fixed income, commodities, etc. And I would love to hear a little bit more about FTSE All World.
Yeah, so maybe briefly let me introduce you Invesco and then also what FTSE All World is about. So Invesco does active and passive. So we have 1,500 billion in assets, 500 billion in ETFs. We do physical and synthetic. Later on, I might have the chance to speak about that as well. And FTSE All World is a quite interesting index, I would say, because with one ETF or one index, you can be invested into the global equity market, which means you're invested into more than 4,000 stocks, approximately 50 countries from the developed space and emerging market space, which means with one vehicle, you get the investment into the full spectrum of global equities. And you can start up to 5 francs actually to invest, because that's
great.
Yeah.
So you can basically participate in market development
in the
already
entire market.
It's
so
nice
there is no need to go to single countries or whatsoever. You could do that, but here it's an easy vehicle for investors to choose the FTSE All World.
And to my understanding, also from what I've seen, is also cost efficient, right?
Yeah, it costs 15 basis points, which means 0.15%. So it's the cheapest way to invest into global equities, including emerging markets, and is physically replicated. So we really buy physically those stocks, and so it's done by our portfolio management team in London.
And that's amazing. And very interesting. So there's, for those of you out there who are actually relatively new to the ETF space, there are different index providers, right? FTSE is one of the, I think, predominantly UK-based index providers, but they obviously provide global indices. There are indices like MSCI, S&P, basically index providers, etc.
That's correct.
Just to have also put a little bit of explanation around the names.
Sure, yeah.
What would be also interesting to think of is, and that's another question which reaches us a lot, particularly from our younger generation investors. We are very often asked, how shall I start investing? What is the best split for my money between the various categories? Equities, bonds. Shall I buy gold? Shall I sit on cash? And all those type of questions. We would translate that question as what should be my asset allocation. But
I mean, if I would know that, then most probably I wouldn't sit here. No, I'm joking. Joke aside, I mean, the longer your time horizon is, so I mean, let's say you start with 20, so you have another 40, 50, 60 years, be invested into to equities. So I would really go into, let's say, 100% equities if you're young. The older you get, the more you can tweak the allocation towards also fixed income. Yeah, that you then say 60% equities, 40% fixed income, because that dampens a bit the volatility, the risk of your portfolio by having fixed income in the portfolio. Now, what is important is as well, what are your plans in your life, right? So if you want to study and need certain amounts for your university degree, tuitions, or if you want to buy a car, or eventually you want to buy a property, based on that, you can also invest and look at the payouts, etc. So it has many factors. There is not one right answer, but what I can say is really start young with equities, and then shift time over time into fixed income as well. The other thing around commodities, the problem with commodities is it's a bit maybe complex, but there are roll effects. Yeah, so you have roll costs. So if you take commodities for a long period of time, it can get quite costly because you don't want obviously the oil, the Brent crude delivered. So you buy futures. So I wouldn't recommend, to be honest, to invest in commodities.
People who are not experienced,
right.
I agree, yes.
So it's really for short-term investors, for experienced investors. Gold is different, but you can invest physically into gold. In market scenarios where you have political risks, where you have instability in the system, gold makes sense, but I wouldn't allocate too much into it because it has no dividend, it has no...
It eats up the money actually.
Coupon, exactly. So it's storage of value, but it doesn't really provide you any income, which equities for sure do, and fixed income as well. The other aspect that you mentioned is around cash. Should I keep cash? Okay, we look now at interest rates, which are increasing. So we have bank yields of around 1.75% for certain banks, which is pretty attractive. But always look into the inflation rate as well. Yeah, so what is the real value of your money then? And that's important. So take the inflation rate, take the interest rate you get, and that's really what the value of your money is. And most of the time, actually, your money, if it's in cash, has less value.
That's true.
So I would really recommend a good portion should be invested on a regular basis. And you can have a bit in cash, but I wouldn't do too much, to be honest.
Thank you. Yes, we see it exactly the same way. Particularly the cash aspects is very important because there was recently a very interesting study. There were very few banks in Europe pass actually to their clients the interest rate increase. Yeah. Typically, as you say, it's certain percentages, probably up to 50-60% from the current interest level. And with the inflation which we have, you end up having a negative yield on cash, which very few people are aware of.
It's not ideal.
It's not ideal. And
maybe one word actually to cash. The safety investing into financial product, into mutual funds or ETFs is higher than if you invest into cash with a bank if the bank defaults.
That's true.
Because you have only the guarantee of 100,000 francs, which is an aspect to look at as well, right?
From credit risk perspective, you're absolutely right. That's something which is very important for the people who listen out there to know. Of course, an ETF has a equity market risk, and which we measure with the volatility. But any kind of deposit above certain level has actually credit risk, and we don't. I remember when Lehman defaulted was the first time when people started talking about credit risk. Before that, people were not aware, and now with Credit Suisse being acquired by UBS, this topic came again on the table, and it's very important to be aware of the type of risks which an investment bears, and a cash bears inflation risk, and obviously also credit risk
Correct.
above certain amount
Correct.
of
Yeah.
and the opposite, obviously, from the different type of risk which ETFs bear are either the interest rate, the duration risk,
Correct.
if you're a fixed income investor, or if you're equity investor, you have the market risk, the equity market risks. But you raised a very important point. If you have a very long horizon, it's definitely worth putting a serious amount of the money which you would like to invest in the markets in equities, because long term, over the past years, any type of study would show that markets are growing on average between 6 and 8%, depending of which part of the developed markets we're talking, and emerging markets partially, depending on the market even more.
That's true.
And this is something which is important to consider when taking allocation decisions. So, having discussed that, we often also have another question from our users on your mushroom, and also from our listeners, and that is, but then shall I buy single stocks? Or now everyone read about NVIDIA that went through the roof basically this year. Or artificial intelligence is a very hot topic, and everyone's like, hey, but what's the key player who's going to make the run long term? What's your view? Would you also, in addition, buy single stocks?
You know, I used to buy single stocks, which was 99, 98. I got burned in the into the dot-com bubble. The problem with single stocks is, if you look, every decade you have a new trend. I mean, if you think in the 2000s, we had companies which most of you wouldn't know anymore. AOL maybe was a big thing, right?
People don't remember that.
Most probably you don't remember. Yahoo was a big thing. Of course, we know it, but back then it was one of the big IT companies, they said.
Yes, it was one of the tech giants or the big tech.
Yeah. And then I think one of the top 10 companies was Walmart eventually. Later on. Yeah, so there were so many top 10 names globally. And then in the 80s, it was a lot of Japanese companies because they were tech-wise really on top notch. So it's changing. Every decade is changing. So the top 10 names changed on a regular basis. So selecting on an individual basis a security is really not easy, not something straightforward. So what I say is, just go with the index. Just if you're positive on technology, go into NASDAQ 100. Right? Because then you have the largest 100 tech names, and you're exposed to Meta, to Apple, etc. If you think, okay, I don't want to have the concentration risk, then you can buy a NASDAQ 100 equal weight, for instance. Yeah, then you have an equal weighting. But the single securities, it's not really not for the long term, I would say. To be perfectly honest.
That's very interesting. Thank you for this insight. That's a great insight. And yes, I mean, I see what are the arguments for that. And thanks for sharing. But you mentioned US market. Let's stay with the US market.
Sure.
What's the best way to invest in the US market? Because it's the biggest equity market at the moment.
Yeah, I mean...
they have also regulatory aspects, right, with the dividends, and that's something which very few people out there know.
Yeah, I mean, first of all, if you look at the US market, it's really, really tough to beat. Yeah, I mean, over 10 years, there's not one single active manager that can beat the US equity market.
Oh, wow.
Yeah,
it's so very liquid market, right?
Yeah, because it's so efficient.
Yeah, it's super efficient.
You have a very efficient market. It's a super liquid market, and there is a way how you can generate an interesting, attractive return via ETFs, which is there was a regulatory change in 2017 in the US. It's called Hire Act 871M. So it's quite nerdy details now I'm disclosing here. So basically, this requirement said there are a handful of indices, such as S&P 500, which is the largest index, same like MSCI USA. So you have the 500 largest companies and a bit more for the MSCI USA, where you invested. On these two indices, there is a future. Yeah. So what they said is, the US regulator said, there is no taxation on the MSCI USA or S&P 500 if the replication method is synthetic.
So you don't have the withholding taxes of impact of... almost 30%, right?
So the
on
US withholding
dividends.
tax rate is 30% on
Dividends,
let's
yeah.
say 2% dividend yield.
Yeah.
So to do the math, because usually most investors select the ETF, which is the cheapest. They say, okay, 6 basis points, 7 basis points. So we
Yeah.
speak about 1-2 basis points difference.
Yeah.
But here we speak about 2% div yield. You take the 30% withholding tax rate, you multiply the two, so you end up with 60 basis points.
Yes.
Additional taxation if you invest into a US domiciled ETF, for instance, on S&P 500, or if you select a physical S&P 500 ETF, where you are taxed between 15 to 30%, or you go the synthetic route and you save the US withholding tax completely, which is a massive benefit. So we saw I mentioned before in 2017 that was implemented, this rule in the US. In 2018, we changed our ETFs to replicate exactly this index, which is the gross index, so without US withholding tax rate. Our ETF, our MSCI USA ETF, was back then 70 million, so 70, which is in our world very small.
That's true.
Now it's 4 billion.
Oh, wow.
Similar route, our S&P 500 was around 1.5-2 billion. Now it's at 18 billion, so the largest synthetic ETF in the market. And it was really just around the taxation benefit that the US regulator allowed.
But you know,
back
50
then.
basis points over 10 years, those are 5%.
It's 5%.
Performance you have
Yes,
or not
it's a
you
lot.
have, and,
Yeah,
and it's
yeah,
it's quite
yeah.
a lot.
Yeah,
And it's basically more or less an average 1-year performance of the index, right? So you give
Exactly.
up for... No, that's very interesting, and it's good to know, and thank you for sharing this insight.
yeah, you're welcome.
What we very often also see as a topic, and that's an evergreen since years, is sustainability.
Yeah.
And we know that Invesco actually is at home with
Yeah.
this topic.
Yeah, that's
So,
true.
Happy to hear.
I mean, ESG investment, sustainable investment is very important. Yeah, there are a few aspects. One, of course, it makes sense if you invest, to invest green, right? But there are two lines towards that. One is investors who want to be green, but not to have huge tracking errors towards the traditional benchmarks. So for that, you do have, let's say, light green strategies. That's what we offer as well. But more often, what we hear from investors is, okay, I know I want to be sustainably invested. At the same time, I want to have CO2 reductions and according to the Paris climate criteria of 1.5 degrees. So what we launched on various regions from the US, Europe, Asia, etc., was Paris-aligned strategies who do the filtering around those companies who commit to reduction of 1.5 degrees, plus strong ESG and sustainable criteria. So really dark green, and that's actually we see a lot of attraction on that side, specifically from the younger generation.
Yes, it's very interesting. It's, as you say, the younger generation is incredibly sensitive to the topic, and
yeah, and that's important, because if we want to make an impact, and if we want to stop the global warming, everything. I mean, we sit now here in this month, and it's very warm.
It's above 20 degrees, mid of October soon. Yes, that's
exactly.
unusual. That's true.
And so we need to start. And how can we start earlier? It's really if we already make this impact in our portfolios, in our investment decisions, and as an investor like Invesco, with 1,500 million assets, we go into engagement with the company management. We tell them how to do things differently. With gold miners, for instance, there are ways how you can mine gold, which one way is more expensive and is sustainable, versus the other, which is cheaper but unsustainable for the nature. And we really push them to go the sustainable route.
This is super interesting, because one of the biggest problems, and I'm very happy to hear that, one of the biggest problems which we normally also hear in conjunction with ESG is the so-called the issue with the data, with the quality of data. And if you're monitoring them so close to an extent where you really go in and get engaged with the companies, so you're proactively actually tackling this issue, which is amazing. That's very interesting to hear.
So it's not just the votes we give, it's really we go into the engagement with the management.
And you would obviously also screen technologies and the way how they operate.
Of course.
So you do due diligence a lot. That's amazing. It's very interesting to hear. And a lot of users out there and listeners would be, of our community, would be happy to get more insight on that as well. And speaking of that is also when it comes to ESG and when it comes to really addressing, you mentioned before, little tracking error to the regular investments. What we believe, and that's something which we've been observing, I believe over time there would be kind of a narrowing of this tracking error probably would disappear towards the standard kind of investments, because more and more institutional players are going into ESG. The next generation are completely into this topic. But happy to hear also your opinion on that.
No, I mean, that's clearly what you say. I mean, it's not only millennials and younger generation. I mean, we see it with big institutional companies who change their benchmarking. They go away from traditional benchmarks to sustainable benchmarks. And that's exactly a step towards this direction. And tracking error, yes. I mean, if you start excluding out of traditional benchmarks also certain sectors and companies, of course, you're absolutely right. Tracking error then diminishes over time.
And it's interesting to see how actually people start getting aware that the money has a voice, and they start proactively putting their money where their core beliefs are and what they would like to change in this world, be it climate change, be it education, be it a more fair world with terms of equal chances for anyone, etc. It's really good to observe those.
It's two things. It's the voice and the leg.
Exactly.
Because they can walk away.
You're right. You're right. Yeah. You can vote with your money, but you can also vote with your feet.
Yes.
That's very good. That's very, very good stated. And I think on that note, is there anything you would love to tell to our audience out there, which is dear to your heart, which it might be an experience from your career, or kind of an advice, or kind of idea of what one can do better with their money, and
in terms of investing,
whatever you would like to share.
So,
career choice investing.
Career choice in it. Let's stick with investing. Maybe I'm better on that. So I would really say stay invested. What is important? There is actually one statistics which says 93% of the performance is the strategic asset allocation. So just be top-down invested. And the rest, in market timing, that really can destroy actually your performance. If you go in the wrong time, you go out the wrong time. So stay invested, get educated. I mean, that's an important thing as well. I mean, if you go and buy, let's say, the newest iPhone 15, you know exactly the processor, the camera, etc. You spend, I don't know, it's 1,000 or I don't know.
1,200, 500. Yeah. Well, it's quite expensive, actually. It's.
If you invest usually over a year, maybe bigger amounts of money. But many people don't really go into the details and look into it and educate themselves. So I think education is a key driver for being successful, no matter in your career or your investment portfolio or getting the right phone. So get an education and look into details. And if you have any questions, just ask the experts. I'm not sure if you guys have a chat or hotline.
We do.
Yeah,
you
so
can always.
amazing.
Thank you for that. You can always write at hello@mushroom.com, and we're super happy to support and help. And what you were writing, also one last remark on my side, which just came into my mind, and we keep stressing that, as you say, it's get educated, but also get aware where your money goes, because a lot of people say I don't have enough money to invest. And in current technology, people can start with very little, and it's great to buy an expensive gadget. It's great to buy a gadget which is dear to our hearts, but a lot of those things. Now, an iPhone is something which people write. We're so used to that. But a part of this field, there are a lot of things which I'm sure every one of us has perks which we buy out of habit and maybe don't need, or not to that extent. We keep laughing with our coffee consumers in the team that they may save a coffee per week or 2 coffees per week, and then they have their money to buy an ETF over a month. So be mindful about how you spend your money and spend time with this idea.
Good point. There are really good books on that as well, actually.
You're right. Yeah. One to recommend?
I'm just thinking there was one. I forgot. I will send you the name.
Happy to.
Maybe you can share it.
We should share
there's
it.
some interesting books on that.
And that gives me
It's
an idea.
actually more around experiences. So
Yes.
if you spend something, spend it on experiences and less on I don't know, gadgets and I don't know, brand clothes or something like that.
Yes.
So that's because that's what sticks in your mind, and I think that's
that is probably, you know what? Now that you're saying, do
forgot
you
the
remember
name
this
of the
book,
book.
5 Things People Regret before they die? I think it goes into that direction.
Yeah.
Not having enough experiences, but having worked for basically building, I don't know, chasing some kind of a status symbols, etc. I think I've heard that one from that book as well.
Yeah, it could be. But the one I'm referring to, where I've forgot the name, unfortunately, is a different one. But I share it with you later on.
We have to.
You can share with the audience then.
Great.
Yeah.
Great.
Cool.
Well, thanks a lot for
thanks.
sharing all these super interesting ideas with us.
Mm-hmm.
It was a pleasure to have you.
Yeah.
And for those who have questions, either to us or to Nima, please write to hello@yourmushroom.com. We're super happy to answer, and we're quick in answering. And we are really eager and looking forward to seeing you and hearing you again here. Thank you.
Thanks. Take care. Cheers.
Bye-bye. Cheers.
Bye.
Money!
What Your Bank Doesn't Tell You, a podcast by You Mushroom.